We will now turn our focus to the first panel discussion for the day. May I invite Rosemary back into the virtual room, as well as all the panel members. We have Anouj, we have Dina, we have Nicolas, and Peter and Robert returning to the stage. And we do have in our presence, we have Peter physically here today, and everyone else will be returning to the room virtually. So would you be so kind to take your seats? And then I'll be handing everything over to Rosemary for her to facilitate.
Thanks very much, and I will start to frame up this discussion as we're waiting for others to enter the room. Since we last spoke before the lunch break, and we talked about the bringing together of public and private capital and different forms of capital, you've heard from each of the people who we're now going to have on this panel about some of the work that they're doing and how that is bringing different approaches together. What's lovely about this forum is that it starts first not with the finance, but it starts with what the issues are that we're all trying to address, and then looks at the tools that we can bring around that. And in this panel, I'm hoping that we can explore more with people this valuable tool in that context. You've heard already that flexible finance and blended capital can take different forms, that sometimes it's about bringing together grant capital with finance. Sometimes it's about coupling the capacity and the resources for capacity building and for technical support and building the business and revenue models around the ways that we might bring funding and finance into things. This is a really powerful but still underutilized tool, and you heard Keith talk before about the fact that this is really about catalyzing and mobilizing at its most powerful rather than subsidizing. And we can see sometimes that where it's used poorly, it does become a bit of a game of risk and cost shifting. And we've all seen that in former iterations of public and private partnerships, and how often that doesn't serve the interests of the parties, either from a financial and economic perspective, and certainly not in terms of some of the outcomes that we're seeking. So when we are talking about this today, you'll hear from people experienced in making some of these blended capital models work, either in driving the finance side of it, or in bringing it together in the work that they are doing to achieve better outcomes than what we could achieve without that. And in particular, in encouraging markets to go into areas where they may be less inclined to go, so that we can continue to have an ambition and an aspiration for the social and environmental innovation as well as the financial innovation, and to continue to see new ways of delivering better outcomes for people and the planet. So with that, I'm going to hand over to Keith. Keith, you spoke with us earlier from Convergence and standing in for Robert today. And people have heard about your background across areas of finance and working with clients who are interested in sustainability across a range of geographies and different types of organisations. Can you help orient this conversation in terms of blended finance as that important tool, and pick up on some of those key features that you talked about earlier in the context of water and blue finance?
Sure. Well, thank you, Rosemary, and again, good afternoon to all of you. Good evening to all of you from Toronto. I think, Rosemary, I'll break your question up into two. One is sort of the importance of blended finance, why blended finance, how does it all fit in here? And then we'll tackle the water piece. Imagine a world in which we did not have any private investment. We would have roughly $150 billion of official development assistance support to solve all the SDGs that we're talking about, because that's what the number is, $150 billion of ODA that's available, and arguably that's going to be decreasing over time as GNI decreases because of COVID-19. Now, of course, you've all heard about this $2.5 trillion Sdg funding gap. So you've got $150 billion of supply, $2.5 trillion of demand. Now let's put that in context a little bit. $2.5 trillion is roughly 3% of global GDP. It's roughly 1% of the value of global capital markets. and roughly 14% of value of global annual savings. So the money is there. The money is very much there. It's just sitting on the sidelines, invested in US Treasuries, invested in safer assets in Australia and Canada and in Spain, other countries. Now, according to the United Nations Sustainable Development Solutions Network, the funding gap for water in the sanitation space is around 260 billion. Still a large amount. So how do we get private investors who are sitting on the sidelines with these deep pockets interested in the projects that you and I are trying to structure? Or for example, in the project that Nicolas just so eloquently laid out for us earlier. So that's really where I think, blended finance really fits in. It fits into this idea of mobilizing this pool of capital that's sitting on the sidelines into these projects that you and I care about. Essentially, with respect to two ideas, right? One is to reduce the gap between the perception of risk and the reality of risk, because oftentimes investing in water, investing in developing countries, there is a perception of risk that an investor sitting in New York has versus the actual reality of risk on the ground. So can we use blended finance structures to narrow that gap between the reality and perception of risk? Oftentimes the risk is real. So how can we use blended finance to change the risk-return ratio for those investors such that they'd be more inclined to participate in those transactions? And that's essentially what blended finance is trying to do. Now, when we look at the water space, I mentioned earlier, we have around 36 deals that we've seen that are blended in the space, roughly $2.5 billion of quantum of financing. But a lot of those deals are primarily oriented towards water infrastructure at the utility or municipal level, or even last mile delivery. That's usually where a lot of the nonprofits or foundations or impact investors play. But we need to reframe the concept of blue finance to think about water as an overarching theme, not just SDG 16, but also SDG 14, equally important, if I would argue more important. And oftentimes SDG 14 is left out of the conversation. So I think we need to have an overarching theme when we speak about water. But water is not an easy asset class to finance, because of the things that I mentioned earlier. And so blended finance really has the flexibility to tolerate those risks and that complexity. We're supporting at Convergence, we're supporting folks like Nicolas to design those bankable vehicles and structure those transactions that we need to structure. But it's not always about innovation. Innovation for innovation's sake is also not encouraged. It's about scale as well. So how can we get transactions that are not that complex, but we need to scale? So scale and innovation both need to be supported, which is why we have a design funding window. We support scale, but we also have a lot of transactions that we're supporting on the idea of innovation as well. So that's really what I wanted to speak about, to frame this. And I just wanted to mention, ocean outcomes with the Sustainable Seafood Fund we've supported, Blue Finance and the Blue Finance Facility we're supporting, but you also wouldn't have projects like Al Samara water waste treatment plant, big water waste treatment plant in Jordan, extremely water-stressed country, would not have happened without blended finance. Kigali bulk water project, the first PPP in the water space in sub-Saharan Africa would not have happened if it wasn't for blended finance. So it's really overarching, really taking risks off the table or reducing the gap between the reality and perception of risk. So that's really why blended finance is important and that the role it can play in the water space. And I'll stop there.
Thanks very much, Akifa, and I think you've given us some great material about the kinds of things that blended finance can help to happen, including helping to break down barriers to entry into unfamiliar territory, creating a multiplier effect where there are things that work that need to be scaled or replicated. So I think the water is a great example of where that can really break things down. So Nicolas, we're going to come to you, and you've just given us a lovely presentation about the work of Blue Finance with all of those beautiful pictures of oceans as well, and the environments that are so precious to our planet.
Maybe I can jump to the next question just to avoid this long silence. Meanwhile, she come back to us. I think her next question was for me.
Can you hear me?
Basically, she was asking about a concrete example about Blue Finance. And she wanted to know much more about the key aspects to making this work in terms of blending public and private for marine conservation and revenue for sustainability. So I will take it from there and waiting for everyone to reconnect. So basically, as Akif just mentioned it, I think I'm going to add more specifically about this specific segment, which is protected areas. First of all, I think it's quite new that we can call protected areas an asset class. This is quite new. I think no one has been working so much in making protected areas, both terrestrial and marine, as an investable or bankable product. This is very new. There have been some long track record, like African Park Network, Peace Park Foundation. You have some marine protected areas in Bonaire, in Indonesia, that have been for a long time, more than 15 years, run as a PPP, as a public and private partnership. But really, no one was thinking of you calling a protected area an asset class. So I think from our side, the blended finance approach that we are dealing with is first to break this paradigm. We have to showcase that in some cases, marine protected areas can become bankable, and it can be obviously bringing the expected impacts. So that's one of the first challenge is, okay, protected areas can be an investable product. So to get to this, we have obviously to develop some tangible business models. We have to incubate all the project and all the protected areas towards these financial revenues, which is something new. This is a new culture of entrepreneurship into a marine conservation world, which is also a challenge. So all of this to say that we really need blended finance in that case. We can't just go to a bank or an impact investor and say, okay, the MPA is there, the business model is there, this is the revenue from user fees and from blue carbon, just give me $2 million and that will be paid back in 6 years. But it's not going to happen like this, at least in the next 5 or more years. Okay, we need more incubation, we need more technical assistance to make the protected areas investable. So this is where the blended finance, in our case, the blended finance is a mix of technical assistance, grants in that case, with concessionary loans and more commercial finance or basically debt. Okay, we're not dealing in anything with equity here. Everything is run by a non-profit and a social enterprise, so there's no shareholders, and we want to maintain it like this. I mean, it has to be very clear that protected areas nature is not going to become an equity by itself. So everything is through a commercial debt or through grants or refundable grants. Okay, just want to make this thing clear. So this incubation phase where we make the MPAs, the protected areas, investable, this is where the blended approach is very important. We need to incubate it. We need to take time. We have to prepare all the people and all the culture around this entrepreneurship so that we can ensure that the revenues are really going to be implemented and delivered as expected. Okay, so in that case, what we did in our pilot sites in Dominican Republic and Philippines, and what we're going to upscale with Convergence and other partners is really to incubate and accelerate the incubation of these projects and to make them investable through a facility. So we're going to aggregate also these projects instead of dealing one by one and having a very small tickets of 2 million US. We're going to aggregate them and at least create something a little more attractive for impact investors in terms of transaction cost and also in terms of risk diversification, in terms of product diversification. So this is very much in the early stage for the facility design. We maybe think we have several options, can be a holding company, can be geographically scope, but that's the idea. So just to make it as a sum up, we need to accelerate the pipeline. We need blended finance for this, mixing grants with impact investors. And we need also to aggregate the different projects to make them bigger and more attractive for investors. And that's from my side. I can go on for many times, but here I think we are alone. We are on our own, which is great. This is think out of a box and make it work. Next,
Thanks very much.
Over to the floor.
Thanks very much, Nicolas. And can I just get a thumbs up from a couple of panelists if you can hear me? Excellent. So thanks, Nicolas, and it's such a superb
Anouj,
example.
I think you're the next. You're the next one on the list.
Yeah, I think Nicolas can't hear me, unfortunately. But his example is a beautiful one about the applications of blended finance in areas where finance hasn't been used to going, but where we have really important work to do. Anouj, we heard from you talk about some of the ADB's work just before the lunch break. You're obviously based in Manila and bring a lot of experience from mainstream finance now to a multilateral bank. How are you thinking about putting together structures and what is blended finance helping the ADB achieve in its programs that you wouldn't be able to do otherwise?
Thanks, Rosemary. Hopefully you can hear me, and I can hear Nick as well, but I think Nick can't hear you. So I'm glad to be here. I think just following on from the points Nick was mentioning. Even if let's just start with the proxy for the requirements, and just in the Asian region, if you just look at climate-adjusted infrastructure, of which the water sanitation sector is a part, you need some $1.7 trillion a year. The financing in Southeast Asia is 210 billion a year. And even if you look at it as a proxy, the private capital coming in from different sources, you've got, let's say, green bonds. It's something like 13 billion a year for green bonds and green loans for Southeast Asia versus 200 billion needed a year. So it's quite a huge gap in terms of, even as a proxy, the amount of money that's coming in from commercial finance. And so the financing gap is huge. And the second part of it is that the underlying projects, especially in this sector, and if you go further away from municipal water sanitation towards coastal oceans health stuff, that's even more unbankable very often because the revenue streams aren't there. I mean, you don't have users, forget about, setting tariff levels because you can't directly connect pollution in oceans sometimes to users. So you have a big issue, and therefore, I think the private capital scale that you need is not flowing. And ADB, of course, has, is trying expressly to try and ramp up, the focus of finance in this area. They launched an Oceans Action Plan in May last year, which is aiming to catalyze 5 billion worth of financing from different sources, including co-financing, into the sector, oceans health-related projects, focus on 3 or 4 different areas, and specifically within that, I, for example, work on the ASEAN Catalytic Green Facility. And we have a 350 million committed amount of money from the government of Korea for that. And that essentially is trying to do leveraging or blending or finance better. So what we think is, we should be leveraging public sector funds from the ADB or from a government into sectors where we can de-risk those projects. Can we reduce the cost of capital from the overall cost of capital for a project, making it more bankable for the private capital to come in into the balance funds? Can we come in and actually provide some revenue support for the first few years of operations? And those are the approaches that we are trying to build into the initiative that I'm leading, which is the ASEAN Green Facility. Now, having said that, and obviously the objectives of this are threefold: inclusive development of projects which allow access to all sections of society, sustainable use of resources, climate change, probably the most significant visible part of the work that I do, which is resilience in investments, but all covered by this issue of how do we catalyze 3, 4, 5 times multiples of financing from commercial, PPP, bonds, all sorts of areas using some of our ADB funds. And perhaps the last thing to mention there is we are seeing already maybe 2 or 3 countries in the ASEAN region asking for help to develop, let's say, blue finance mechanisms on the ground. So a localized de-risking facility, which would pick up 10 to 15 projects in coastal protection, marine fisheries, MPAs, and use some amount of funding from a government or an ADB de-risk those projects. So this is almost like my fund, which is the ASEAN fund sitting in Manila, is of course a regional fund, and then a sub fund which would be at the national government level, which then would then take forward this de-risking at the national level. So hopefully one or two of those facilities will actually come to fruition in the next few months, actually, and you'll start seeing some of the impacts there. So that's a quick sort of run through from me. Back to you, Rosemary.
Thanks, Anouj. And I think to put a very kind of crude summary around what you're saying, that the ADB is able to use the catalytic capital to bring private sector into areas that it wouldn't otherwise go, particularly in markets that are less familiar, and also to try to create this multiplier effect, so that what you could do with your own money might be this much, but your money plus the private capital means you can do this much. We'll move now to Peter and the work that you've been doing through a range of engagements in the different roles that you've played, including, Peter, working with a lot of the multilaterals and with how they utilise ODA, and I'm interested in your experience in particular around the blended finance and the SDGs, and how do we think about it? Many of the panelists have mentioned here, and we've heard other speakers talk about this, the financing gap or the financing opportunity. Whichever way we frame it, how can blended finance help us to close this gap and to make progress, particularly in the current circumstances?
Thanks very much, Rosemary, and pleasure to see you again, and hi, Akif, as well. And great to meet everybody else on the panel. Thank you to the International Water Centre, Oksana, and the team for putting it together. And of course, just to reiterate, acknowledgement of traditional owners of our land and elders past and present. Look, I think one of the interesting things about blended finance is that it is a little bit tarnished by seeking the low-hanging fruit in order to get the momentum going, in order to build a significant, if you like, portfolio of proof of concepts. We're really dealing with lower middle-income countries, a lot of infrastructure, and we're still sort of doing the sort of millions to billions thing. So the leverage, the exponential, just isn't really there. The rhetoric has certainly changed to billions to trillions, and Convergence, for example, is very, very firm that really they're trying to unlock the big deals now. So they're really trying to be that catalytic entity that is able to de-risk to the extent where you're getting more market-based interventions in. But it's, frankly, and I think I want to be a bit of a voice of not pessimism by any means here, but I really wanted to riff off Akif's comment about, the role of private capital and how much is really going to be needed in terms of dedication to achieving the SDGs. And as I mentioned in my talk earlier on, it's the vast majority of these investments. So I'm talking now about harder investments, more institutional investments. They're making money to go back to their shareholders. That's a given. That's the purpose. So we always used to say in our discussions in India, the purpose of business is business, and it's true. There's only so much that we can hope in terms of focusing this private capital into shifting the needle on movement towards the SDGs. And I don't say that to be a wet blanket by any means, just to really bring an ultra highlight to quite the challenge confronting us. I think in terms of where we're seeing the opportunities for this space life underwater, we are, a couple of opportunities have been put forward over the course of today. The Queensland Nature Fund was really interesting because they're not doing anything particularly rocket science. It's buying up land, rehabilitating it, and flipping it. And yet it's beautifully simple and impactful. And sometimes, you know, again, I'm sorry, I'm like relying on your words to make my point. But again, innovation for innovation's sake is not the point. What we're trying to do is scale up the good ideas. They can be simple, they can be things which have worked at a smaller scale elsewhere, that we really want to give more oxygen to grow in different environments. So there's a huge amount of, I think, hyperbole, which is focused around private capital and impact investing, and I think, I don't know, but maybe, Rosemary, would you agree to me that the addition of impact in front of investing is a legacy which we should probably try and be moving away from now? Of course, I know you're on the board of the GSG, and you know that is very strongly around the intentionality and the measurability of the investments. But really, when you've got you know, all of the major money managers in the world, from BlackRock down, saying we need to just be investing smarter and better, and focusing all of our work within the Sustainable Development Goals, which, you know, I know we've all seen the Special Rapporteur Philip Alston's report come out a couple of weeks ago, scathing about the SDGs. I dig it, but, you know, look, it's the only game in town, so what are we going to do? You know, let's really start owning this and stop, you know, with the second guessing for another 5 years, and then we can start thinking about what happens post SDGs and a whole new set of frameworks. But for the time being, we have to focus, we have to double down. The United Nations Global Compact, the very obvious emphasis towards the private sector and to private capital in the fight towards achieving these goals. They're all, I think, in the current sort of cut and thrust of the battle, there's differing opinions, but it is all shifting the dialogue more towards, if I can put it down to one thing, that's sort of the measurability of the change. So whereas the MDGs were more that sort of aspirational, we really want to move everyone's knowledge more towards the changes that we need to make in the world, here with the Sustainable Development Goals, and I know I've just did my communication on progress for my own company, and, you know, where a private sector is being put their toes up against the fire to say, well, what are you actually doing? How are you quantifying it? What are you actually giving back? It's a really challenging and confronting set of principles that they've baked into the compact, but are really valuable. And I suspect in 10 years, when we think about the achievements of the SDGs, it will be much more around putting quantitative frameworks and structures that we can actually measure our real progress towards, rather than the aspirational and motivational and sort of more optimistic side of things. Rosemary, I feel very strongly that I haven't answered your question even at all. But I think what I'd like to say at the moment is that blended finance 2.0 that I had in my slide, we're not there. We don't have the common metrics, the frameworks, the terminology. We don't have the case basis. And so the work that Convergence and OECD particularly are driving in this regard, super critical. But we're just not there yet. And I think as a sort of very, very interested but slightly outside of the mainstream participant, I can say that without fear or favour. I'm a true believer. I'm going to continue working along this path because I do believe in the potential of these principles. But there's a lot of fluff around at the moment. In terms of some of the pictures I've seen today, it's all nice and impact-oriented, but it's not hard. You're not going to get the hard money flowing your way with the pictures I've seen so far. And I think you've got to really frame what it is you're asking for. Are you asking for grants? Are you asking for soft loans? Are you asking for equity? Are you asking for straight up vanilla mum and dad investment capital? What is it you're asking? How are you asking? These terms that are being used, equity, investment, impact, development, I don't know, they mean very, very different things to different groups. And until we get to the point where we sitting on the side of the table and talking to one another using these terms and they're being understood in the way that they're being meant, we're going to get a lot of traction lost.
So Peter, you've given us some provocations in terms of the way that blended finance is being used currently, and some of where the aspiration and the rhetoric might not yet meet current practice. Certainly, I think most of the people who I'm aware of wanting to see this field grow are focused on bringing a lens of impact to all investment rather than creating a nice niche where impact sits, that realizing that impact is across everything we do, and what we need to work out is what impacts are material and how we move more from the negative to the positive, I think, is the shared aspiration. I think the point about making impact count is really important. We know that shared language and the way that we can create practice and metrics is a really important part of scaling any industry and endeavour. And I think there is a lot of work that is heartening that's going on in relation to that. Where there is still a huge gap, in my personal view, is between the state of the art in that and the awareness and fluency and capability around the tools that are available in a lot of the different parts of the field. Certainly in this environment, if we had one shot in the locker, I think making impact count in various ways and people accountable for impact is something that will start to move the dial, and I think we're starting to see that. I want to move to Dina, and you gave us a presentation earlier, Dina, building on your role as a partner in Incofin and the work that you're doing in particular around the Asian region and with Danone as a partner. You gave a terrific reflection when you were talking about the fund earlier about this being one example of something where the partners have come together and have done some proof of concept and now want to accelerate the kind of change. As you think about this, often the difficult part of bringing people together is that it's hard for the people who have the resources and the people who understand what the need is to connect with one another. And I think Peter was just talking to that in part about this, the language doesn't match. There's a range of reasons that the need and the solutions and some of the finance don't connect. So as an intermediary sitting in this space, you play a key role in that. So how do you think about that role, and in the work that you're doing, perhaps with the water facility, how are you thinking about managing those different expectations on different sides of the transactions in the fund?
Sure. Thank you, Rosemary. Well, I think a lot of things have been said about blended finance and its need. And I'd like indeed to maybe focus on how it needs to be done according to an impact asset manager that has tried to, be doing hopefully relevant, impactful things for the past 2 decades. I think, we are an asset manager. What does that mean is that we are the bridging intermediary between the people who have the money, as you said, Rosemary, and the people who need it, right? That's the basic of why we exist. And why do we exist? It's because the people who have the money typically would have it for a lot of reasons, would want to put it at use for decently okay or impactful social goal, but maybe not extremely refined, would have not the same understanding on what absorbable in a market, and would have maybe too high ticket size. You have some people who have money and expect a certain return that is just not possible to be reached in the sector they want to invest. So our role is to engage with the asset owners and try to shape the conversation, to channel their money so that it becomes a meaningful investment instrument. And I'm not saying this lightly, because Incofin started its impact journey in microfinance 20 years ago. And microfinance is I call it the grandmother of impact investment. And the grandmother has a lot of scars, has also a lot of beautiful memories, but it has a lot of hidden skeleton as well in the cupboard. And I think it's a very interesting case to look at when you want to understand what could go well and what could go wrong in the impact space in any sector that you look at. Just when I look back at the journey of Incofin, when we moved our pure financial inclusion strategy to agriculture, we were approached by asset owners that were interested in investing in our fund. And and the way that they were screening us was to say, oh, can you provide me your IRR track record, your financial return track record of the past 10 years? Say, we can't do that, but you need to recognize that we've been investing in financial inclusion, and now we are offering you a proposal for agriculture. The return is going to be completely different. We need to shape the way you look at things. And if your game is to tell us that you expect us to reach financial inclusion IR to do agriculture, then we are out of that game, because very likely we're gonna shape something that is not gonna make sense. So I think this for me is a key thing. The second thing I like to say on that topic is that microfinance is an interesting case, because before it was only development money, it was only foundation, it was only grant, and then it became impact. And then when I was saying, hey, I am an impact investor in financial inclusion, I was part of 15 or 20 names. Now, when I say this, I'm part of 200 names, among which I have a lot of people who are just purely doing do no harm or basic ENS stuff, and have conveniently labeled themselves as impact investor. And this is for me where the risk lays, and where we need all to be very careful attracting private capital, because there's such a funding need. Yes, taking the time to shape the conversation and make private capital providers understand what it takes to invest in these sectors. Investing in a sector in a private way to solve a social problem, if it was that easy, then we would have been doing it for 200 years basically. So there's a reason. The reason is because sometimes it does not yet reach capital return. That's it. It's not private market return. It's a fact. You do microfinance in India, you do microfinance in Cambodia, you don't reach the same return. It's fruit of many different things, but you already actually reach quite high return. You move to producer organizations in Latin America, you do cocoa production, you don't reach the same return. You do water tomorrow, you don't reach the same return. And I think we, as the people who've been involved in the impact space, have that responsibility to not let any private capital embodier come to our world and say, hey, in the name of having quantitatively so much more money than all of you guys have ever had, give me the floor. No, we'll give you the floor, but we will be there to shape the structure of the fund, the IRR expectation of that fund, the impact metrics that we need to track, and in order to ensure that what I call we don't end up in the impact washing phase of our industry. And the last point I'd like to make on this is, again, microfinance, for the longest time, we used to say that we were tracking social performance metrics, and social performance did never claim that you were, being able to quantify your impact. You were saying, I am really trying to invest in companies that are socially responsible. I am checking their human resources practices, their client protection practices. I'm checking if they have a social mission and if the board talks about it, or just look at ROE. But I cannot tell you at the end of the day that, and then thanks to this microloan, this woman is richer. I cannot say this. It was called social performance. And then very conveniently, that concept through our industry, because we were suddenly a much bigger, industry of people who wanted to understand what is this social responsible game, we started having to call ourselves and call our indicators impact. And so now, when I track the number of female borrowers of microfinance institutions, I don't know if they're well served, over indebted, if they have one product, if it's the right amount, the right interest rate. I call this an impact metrics. For me, I'm okay to want to use that language if it allows us again to have a mainstreaming, effect to have more people join the conversation. But I think we need to be very careful about this. And in our case, humbly at Incofin, what we've tried to do is to say, okay, we'll track social performance metrics, we'll track output metrics, number of women, rural, and then we'll try to push the agenda further and to allocate technical assistance to track outcome. We cannot claim that this is a direct link between what we've done and what has happened, but at least we can say, yeah, are they better off? Are they more included? Do they have more savings on an account? And I think this also needs to be the second key conversation that we need to have. The first one is, what are the reasonable financial return that each sector can aim for? And the second is, what are the reasonable, not over flashy outcome measurements and impact measurement that we should all agree as an industry, so that this logo game of the UN SDG, as the previous speaker was saying, stops. And so that we don't allow anybody to publish an impact annual report by just putting a logo and saying, hey, look at the story of this investee. It's UN SDG 5. No, why? Did you track any indicators? Do we know if it was better, worse? Are they aligned with any IRIS guidelines? I think this is for us, we have a responsibility. We're not 2-year-old anymore. We've done it, we've failed, we've succeeded, and this is our role to do it and to have this meaningful conversation with our all asset owners, public and private.
Thanks very much, Dina, and some powerful reminders around the fact that needing to be multilingual needs to go both ways, that if we're talking about impact and investment, that both have a legitimate place and an important place in the conversation. That impact washing is something that is very much on the minds of many people about claims that are being made and alignment relative to what's being achieved, or the balance between positives and negatives. And also that there is a spectrum of returns, and some of you will know, and for those in the audience listening to this, there's some powerful work that has been done by colleagues on the returns continuum around impact, and how to think about different types of capital, which has been developed over a number of years now and is really very much worth looking at. I want to thank all of our panelists. We're out of time for questions, unfortunately, but I know that they'll be available in the virtual conference space, and you may be able to ask them questions at a table. Thank you all for a really rich discussion and for the contributions that you're all making in the work that you're doing. And I'm going to hand back to our MC.
Thank you, Rosemary. And thank you for your excellent facilitation and those questions that are coming through. Keep them coming for our panel members.